Broadcast is now starting. All attendees are in listen-only mode.
Well, there we are for our second podcast webinar in a row. Today we're talking about the Biznews Global Portfolio. Welcome. I'm Alec Hogg, talking to you from London, and we'll be going through a extraordinary period. I just wanted to show you the background here. You can have a look at what's happening in London today. A little bit of sunshine, which makes it unusual, but I can tell you it's pretty cold over here. Before we get into the portfolio and the feedback on exactly what's been happening, my colleague Stuart Lohman is in Johannesburg. Stu?
Yes, thanks, Alec. Twice in 2 days. Feels quite special. Obviously shifting focus today, which is great, so the global portfolio. Just quickly from my side, can I see a show of hands as usual, just to see if you can hear me and Alec, and you can see the portfolio, global share portfolio? Yes, I've got a few hands there. That's excellent. And just quickly, as we do like to keep the conversation going with your guys' questions, and if you can please just plot them in on the control panel on the right-hand side. There's a little questions drop-down menu there. Just plot them in there, and I'll send them on to Alec as we go through the portfolio. But over to you, Alec.
Thanks, Stu. Maybe we should just touch very briefly on the big news of the moment on the Johannesburg Stock Exchange, the Viceroy report that's come through, which is telling us that Capitec is in trouble. Share price down nearly 20% last time I looked. It does appear that the Viceroy effect is still pretty potent. We saw what Viceroy did to Steinhoff. I haven't had a chance to read through the report yet. I will be doing so, no doubt, along with hundreds, if not thousands, of other people. My feeling on Capitec, though, from what I know of it, and I have been down to the business, I went there 3 or 4 years ago to go and look at what was going on there. They have a good business model. They certainly are very up to date when it comes to all the information that they have at their fingertips. Where Capitec did worry me was the share price was priced for perfection. It really at almost an 8 times book versus under 3 times book for the other South African banks. It really was a stock that people have actually been pushing maybe a little bit too far. I have said that a few times, and also when you see the chairman and the chief executive dropping tens of millions of rands worth of their own shares or selling them into the marketplace when the share price hit 1,000 rand in December, I did suggest that one needed to take a very cautious look at it. Anyway, it is what it is, but no doubt Capitec will be responding to the Viceroy report in due course. Okay, let's, now that we got that behind us, because I'm sure there are a few people who are going to want to discuss those issues. There isn't really a lot more than I can add, to the Capitec story than that, but I can give you a whole lot of information on the global share portfolio, and we'll be going into that in a moment. Stu, just to make sure, is everything on the screen as it should be?
Yes, everything's as it should be. Alec, I've got a question if you want to kick off with a question from Dirk. He just says, I see that it's an old one we used to have in the portfolio, Novo Nordisk. He says it's recovered again. Do you know if there was a change in the fundamentals, and can an investment be reconsidered?
Yeah, thanks, Dirk. Yes, it can be reconsidered. I see Novo Nordisk recovered on the strength of an attempted takeover that isn't going ahead. So it's a little bit like what happened with Mediclinic. Mediclinic was making a charge for Spire here in the UK. It was unsuccessful. Novo Nordisk it was unsuccessful in getting Spire to agree to a friendly takeover. Novo Nordisk has had exactly the same thing with a Belgian company. They've attempted to acquire them. It hasn't been successful. They've pulled out. Share prices improved. No, I think with investing, you've got so many options to choose from. 3,500 shares that you can look at around the world. To go back to one that has actually not told the truth and that has burnt you once before. Fortunately, that didn't burn us. We got out early enough, but that has burnt shareholders by not giving them the full story. I think you just leave it. It's like Tesco. Would Warren Buffett ever buy Tesco shares again? No. There's always a remnant of the or a residue of the culture that's within the organization, and it's it's best just to go elsewhere. Really, easier there easier opportunities in other areas of the investment market. So that's my view. But if Novo Nordisk, if you know the company and it takes your fancy and you do like the story as it's going ahead, well, if you've done your homework, that's the most important thing. And that's really what we're trying to do here, is to try and say to you, here are the shares that we like. These are the ones we've done our homework on. These are the ones that we keep following, and do the same thing yourself. It doesn't mean that if a stock is not in our portfolio, we don't believe it's worth owning. All we're saying, and all I'm trying to say as a general trend, is please just go do your homework. And once you've done your homework, you can make your decisions on what to buy and what not to buy. But there's our portfolio. That's the portfolio in dollars, and it's been an extraordinary month. We'll get into it in just a little while on what happened in this month. But as you can see, the portfolio is now worth $363,000. It started at $200,000. So that's really the big overall story. And as you can see there, Amazon has been spectacular, as has Alphabet, which has doubled since we purchased them 3 years ago. Apple has come back quite sharply in this past month. That's the only loser in the past month, but all of the others have done pretty well, particularly in US dollar terms. And the portfolio in Rand, you can see there, the Rand surged in the past month, but the portfolio in Rand terms is still up 34%. So that's, annualized over 34%. That means if you'd bought in 2014, December 2014, when we began, you would have made 34% on your portfolio. And it's about right, because if you look at the total value of the portfolio, 4.4 million Rand, that comes from around about 2 million Rand, where we started, just over 2 million Rand. Interestingly enough, though, the portfolio in December was 4.5 million Rand. So it's down about 100,000 Rand in Rand terms in December. And the reason for that should be pretty clear. There we go. Start off with the Rand dollar. We last time we had this presentation was about 6 weeks ago. We did it on the 13th of December, just before we went into the Christmas break. The Rand was at 13 Rand 62. That was 5 days before Cyril Ramaphosa was elected as the as the president of the ANC. And at that point in time, if you recall, I did say that we believed that sanity would prevail within the ANC, and that the ANC is peopled by more good people than bad people, and that they would be that good would always win over evil, and it would prevail in this instance. And indeed, that is what happened. We discussed the issue. Well, if that's the case, if you think Cyril's going to become the next president, and you think the Rand is going to appreciate, what are you going to do about this portfolio? My sense on these things is, of course, if you are a trader, you would have been hedging the Rand value, etc. But that's not what this portfolio is about. This is a Buffett-driven philosophy, if not exactly all of the shares would be owned by Buffett, a Buffett-driven philosophy, and that is you own the shares forever. So your holding period is forever, not for a period of time. So as a consequence, although there was a sense that the Rand would appreciate strongly after Cyril Ramaphosa was elected ANC chairman, we weren't making any changes to the portfolio. Now you can see that the impact of that was very, very significant. The Rand appreciated by 12% against the US dollar since Ramaphosa's ascension, and indeed even more so since mid-November, when it became apparent in some people's minds that it was possible that the Zumanomics trend was going to be reversed. You could see it peaked out, the Rand peaked out at 14 Rand 47, and that's only 2 months ago. How the world has changed. I can tell you more if we get to the questions about the remarkable excitement that surrounds South Africa in Davos this year at the World Economic Forum, where Cyril Ramaphosa was leading the charge. We can talk about that later, but just to let you know that surge in the Rand's value is on the back of a re-rating of the country's economic outlook. As you can see, it's been The rand has been very weak for much of the last 3 years. If I were to take, this is a 3-year graph, if we were to take it back even further, it would show you even worse numbers. The reason why we started this portfolio in December 2014 was because we had a negative view on the future of the rand because of Zoomonomics. And on the other hand, we also felt it was a good idea to invest offshore to get to know the international markets. Now, I think we've achieved both of those, but with the change from Zuma to Ramaphosa, that the first issue here, you're not investing in offshore investments simply as a rand hedge. You're investing there because there is a much bigger market that you can play in. And as we've seen, the performance of some of these stocks has certainly done us proud. As far as the pound is concerned, yes, some people saying yes. Well, the rand, don't believe that Ramaphosa, the Cyril Spring effect is coming through yet. That's not true, because when you look at the performance of the rand against the pound, again from 18 rand 98, you can see it's 16 rand 84 at the moment. So it's a couple of rand appreciation there. Subsequent to Ramaphosa, it's a 7% gain. So even against the pound, which itself has been appreciating, because it seems like common sense is starting to prevail on Brexit, there is a improvement. The rand has improved against that, and 7% is no small matter. Against the Hong Kong dollar, which is the other currency that we need to watch, given that we have a stake, we have purchased Tencent, which is listed in Hong Kong. You can see there's an improvement there as well, from around 184 at its worst to 175 when we last spoke to you. It is now appreciated by 12% since that point, and we're sitting at 154 now against the Hong Kong dollar. That means it's going to cost you R1.54 for each Hong Kong dollar, whereas it was costing you R1.75 a little while ago. Maybe not a bad idea to go and do some of that duty-free shopping in Hong Kong when you get the opportunity. Okay, so that's the story. We have an offshore portfolio which has, in the past month, been affected by a strong performance of the rand, because it's worth less rands than it, or the dollars are converted into less rands because of the appreciation of the rand. Of course, it's a very, very good thing to see the country's currency appreciate, the rand currency appreciate, but it does have an impact on the portfolio. However, as you can see from the individual performance, we still are showing a profit in every one of the stocks. The one that's disappointed most has been Metro Bank, and this is really getting me scratching my head. I do know that there's a tug of war always that goes on between investors and opportunities in a stock like Metro Bank. Metro Bank is growing very rapidly, and as a consequence, it needs capital. So the providers of capital, and as Metro Bank has been doing quite a lot of rights issues, the providers of capital are saying, let's not let the share price run away from us. Then that means we'd have to give them more capital at a more expensive level for us. But at some point in time, that has to break out, one would believe. We're not sure, but as Metro Bank keeps growing, it has to reach a point where the value of the assets that it's got on its book is superseded by the reluctance of the funders or the providers of capital to let the share price appreciate. It's an interesting conundrum that we have there. I was expecting that Metro Bank by now would have appreciated a lot further than it has. Well, there you see the results of it. It's in over a year that we've owned the stock. It's really been a laggard. But on the other hand, the exponential companies have in the portfolio have really done amazingly well. And there you can see Amazon, Alphabet, and Tesla leading the pack. Remember, Berkshire we've had in the portfolio for 3 years, Tesla only for about a year. So you can't really compare those two together. And the overall market there on the Vanguard S&P500 is 47% in the 3 years. So the American stock market has done very well in the 3 years. At Davos this year, Donald Trump was claiming credit, or at least since he was elected in November 2016, he claims credit for the fact that the American share prices have gone up. He says that had he, since he was elected, the share prices are up 50%. There you go, 47% is about right there. And he said, had Hillary been elected, share prices in America would have been down 50%. Well, you takes in this era of fake news, you believe what you like to believe. Apple being a little bit concerning. I'm not worried about Facebook, Microsoft, and Tencent. All of those have performed pretty well, given that they were brought into the portfolio after we began it in December 2013. And there's the reflection of it. As you can see now, the Rand US dollar would have been a really awful investment if we'd taken the money offshore, put it into US dollars, and done nothing with it excepting leaving it in a bank account. We would have done worse than our worst holding in this portfolio. So the decision to take it offshore and to invest it in US equities has worked an absolute treat. Stu, before we go into the individual constituents, is there anything we need to address?
Sorry, Alec, yes. A question from Paul Jeffries. He says, on the FANG type stocks, as they get so big and powerful, do you see regulation coming into effect which might hamper the business plans or growth prospects of these companies?
It's a very good question, Paul. If you read The Economist of 2 weeks ago, the cover story there was all about the challenges that are coming for big tech. In Davos this year, there was a lot of talk around this as well, that big tech has just become too powerful. And I would point you towards the speech that George Soros gave, which we republished on Biznews. In fact, I recorded it. I went to, he throws a dinner every year on the Thursday night in Davos, and it's it's a very well attended dinner, but it is always inspirational. George Soros is a guy who is 87 now, so he doesn't speak as fluently as he would have done in years gone by, but the content of what he puts out there is extraordinary. He talks about the two big things. In this talk, he focused on what's going on around the world, went to each of the areas of the world and gave some insights on them. And then his second part of his talk was all about big tech and how he feels that things have gotten out of control. It's a really interesting debate, this one. Big tech at the moment has done enough, or it seems to be in a nascent stage as far as the attack from the regulator is concerned. It's almost like it's got so big, but it hasn't yet got to the point where everyone's screaming about it. It's the warning signs, though, as we saw from The Economist, as we hear from Soros, and as we saw last year. You'll recall that Google's share price took a knock after the European Union antitrust regulators fined them. So is this the beginning of the resistance from society towards big tech? It looks like it, but it's still early days. So big tech has got the opportunity to change, to perhaps manage the system or the antagonism more sensibly, to adjust its policies where it needs to, or it could ignore that and just keep driving ahead and becoming ever bigger. These are issues that we'll see as time develops. But for now, I just think it's a little too early to start panicking about the impact on big tech of this growing resistance. But if you find it difficult to sleep at night because of these emerging trends, then it is sensible to start adjusting your portfolio accordingly.
Thanks, Alec. Hans just has a question on the trust barometer that you brought up in the Davos discussion. He says, after the crash of the trust index in the US, is it not time to look at some of the European shares?
Hans, it's a really good point. I just want to make another point on that. I listened to the Bloomberg Surveillance podcast, and it's a really good podcast done by Tom Keene. It goes on for a bit long sometimes, and there's a lot of stuff in there that isn't really relevant to the South African audience, but there's good, strong stuff in there. The point I'm making, though, is that Tom Keene, who's a huge name around the world, and certainly within the Bloomberg firmament, he reckons that the Edelman's Trust Barometer is the most important document that is produced every year, and he says it shapes the entire way that they handle their broadcast into the year ahead. So isn't that interesting? He had Richard Edelman in the studio. There's a very good podcast if you look up Bloomberg Surveillance to listen to that, and you'll hear what Tom Keene has to say about it. And this is not a guy who's wet behind the ears. He's very experienced, a real veteran. I think he's been to Davos 14 times, so he knows what's going on in that side. As far as the Edelman's Trust Barometer is concerned, where we must not get distracted is the trust in government in America has fallen through the floor. In fact, as mentioned, it's even below South Africa. Of the 28 countries, South Africa's second last in trust in government. America's even below South Africa, and that was their point. Almost like, wow, how bad is that? It doesn't make us feel too good, but remember that the analysis of the 30,000 plus people who were surveyed was done in mid-October, mid-November. So we're talking about a South Africa run by Jacob Zuma, not a South Africa run by Cyril Ramaphosa. So let's just bear that in mind. The second point, though, is that the trust in companies in the United States has gone up. So you have this strange situation where people in America are now looking to their employers for truth, and they look at government as fake. So no, it isn't the time to start worrying about the trust barometer, the trust barometer's impact on American companies, or indeed on our portfolio, because it isn't. It's actually gone the other way. If anything, you should be buying more American shares, given the way that the American public is now putting more trust into the companies.
Thanks, Alec. I've got a question on Facebook. Do you want me to bring it up when you talk about Facebook, or should I throw it at you now?
I think let's pick it up when we go into Facebook, and I'll then continue with this and just jump in when any of the questions come through. And please do that, guys. When you see if there's something that bothers you about one of the companies that we're talking about, please or you just need elaboration on it, please do tap those keyboards, and Stuart will bring us in. Now, the big thing that's happening in our portfolio, and in fact in the investment markets over the next week, is that many of these big companies are reporting. Amazon is reporting on Friday, and as you can see from this graph, there's anticipation of a monster quarter. Now, I'll take you back to where you see at the bottom that very high volume end November, and you see the share price of Amazon broke through $1,000 a share very decisively with that significant volume down the bottom. That was immediately after the financial results or the quarterly results were released, where after bumping along for a few months, the share price then surged on the basis of quarterly results, and you can then see subsequent to that, the Amazon share price has first of all it's steadied and then went very strongly in the last couple of weeks, and that is an anticipation of another strong set of quarterlies. The view is that that Amazon did very, very well in the fourth quarter of last year, and that, to quote some of the analysts, we're going to see some monster figures. They're expecting that there will be around about $60 billion in revenue reported, and that earnings per share, which really are irrelevant in the Amazon setup, but that they will come in at around $180 a share. That's not really what one needs to look at here. The big thing, as far as Amazon is concerned, is to consider how much of a market share it keeps taking away from traditional retailers. And of course, with the fourth quarter of every year being the Christmas quarter, when people are busy doing Christmas sales, that is the time that you will see that is the time when you'll see how much of a impact there has been on on Amazon's trend towards acquiring more and more of the market that is being held by traditional retailers. So to look out for on Friday, the reports are going to come out after the market closes. So it's giving analysts a lot of time to assess what happens over the weekend, is to see how the web services have gone. Amazon Web Services are expected to be up 40% year on year. Remember, this is a huge part of the business that isn't even put into the valuation of the stocks. And the web services is where Amazon is the number one in the world, and it is fighting there with, the second place, Microsoft and Apple are just a long, long way, and Alphabet are moving into that as well, into the cloud, but they're a long way behind. The other bit of good news for Amazon was that Citibank came out with its latest release to say, its latest report, where it's upgraded its valuation of Amazon, or its target price, as they call it, from $1,400 to $1,600. Now, that's not surprising, given that Amazon is already through $1,400. And the other big issue about all of this is, the primary reason why the Citi analysts believe that's justified is because of a belief of the underappreciation by the market of the opportunity that exists for Amazon in online advertising. That's an area where Google and Facebook have got 70% of the global market, or the US market rather, at the moment, which is by far the biggest part of the global market. And they believe that Amazon, which has got a small share of that market, will be growing it dramatically. In fact, in 10 years, they expect to go from $10 billion to $50 billion. And remember, that drops straight to the bottom line, because they already have this, all of the business model and the costs are to do with the distribution and the selling of goods. If you now start advertising or bringing in advertising on the platforms, it's huge. So Amazon is going forward and forward, and they when you talk about on the Johannesburg Stock Exchange, the Viceroy effect on Steinhoff and now Capitec, when you talk about retailing, it's everywhere in the world. They now talk about the Amazon effect.
Alec, just on Amazon, Fred wants to know, he says, the share price seems to have run quite hard. Is it still a good entry point as of now?
It's an interesting question, Fred, because it is something that we keep being asked, and I continue with the same answer. Yes, just buy the Amazon shares. It's going to bump up and down, but the model is, there is no way of attacking this business model at the moment. You need to just understand perhaps why this portfolio was structured the way that it was, and the longer term perspective on this. And the belief that we have is that we're into a long-term transformation of the economy, the global economy, that is, and that it is being led by the tech companies. So if you can suspend your disbelief just for a moment and understand that the reason why people are talking about the fourth industrial revolution is because it is like the third and the second and the first revolutions, industrial revolutions. And we can go back to the first industrial revolution, which was in the 1800s, where you had this transformation of about 90% of people who were living on farms. Once you started getting mechanical power driven by steam, then they moved into the cities. And you had, today, it's the other way around. You got, people living on the farms are only about 10%, 90% are either in cities or in towns. That's the dramatic transformation that you're seeing. We are seeing that as well around the world in the structure of the economies. And it's the companies that are best positioned for this, the exponential companies, which are the ones that are going to benefit. So if you step away from it and you say, my goodness, Amazon was sitting at $1,200 at the end of last year, only a few weeks ago. Now it's at $1,400. Can I still buy the stock? Well, when the results come out on Friday, we could see it going to $1,500 or even $1,600, as we saw Citigroup is putting its target there On the other hand, if by some miracle, not by some miracle, but if Amazon under achieves what the market's expecting or analysts are expecting, we could see a pullback in the price. My problem with Amazon and many of the other stocks is if you try and time your pricing, it's likely that you're going to get it wrong, because we don't know about the day-to-day movements that the traders are doing. What I would suggest to you, though, Fred, is that it is part of our portfolio. We have 20% of our investment in it. Buy the shares over a period of time. So you can stagger your purchases over 3 months. If you've got, for argument's sake, $10,000 that you want to invest in Amazon shares, by $3,000 or 3,000. I should have said, let's do it differently. If you've got $15,000 that you want to invest in Amazon, buy $5,000 worth now, $5,000 next month, and $5,000 in March. So you'll spread your purchases over those 3 months, and the best you can do is hopefully you come in March and the share price is a little bit lower than it is today. You'll be delighted because you'll be getting the shares cheaper. But as a stock that you should have in your portfolio, it's unquestioned.
Thanks, Alec.
Let's move on to Alphabet, and this has also been a mover, as you can see, since the beginning of the year. Part of the reason, by the way, that Amazon and Alphabet have been moving is the global economy. Remember, these are companies that are invested right around the world, although their main base of earnings is in the United States. When the global economy does well, multinationals like this also benefit a great deal. And the global economy is enjoying a cyclical upswing at the moment. We went to the IMF update of its economic forecast for the world in Davos, and the Christine Lagarde, who is the managing director, said that the world is in a cyclical upswing. In other words, cycles, up and down cycles. We've got an up cycle at the moment for global economy, and as a consequence of that, it's like the tide lifting all boats. So all around the world, countries are enjoying improved economic performance because we're in this cyclical upturn. How long it's going to last is anybody's guess, but what the IMF did say was that this year, because of the cyclical upswing, it is now once again increased its forecast of economic growth for this year for the world. Unfortunately, it actually reduced the one for South Africa, but that's another story. But it increased the forecast for the world, and companies like Alphabet and Amazon would feel that because they are global. The other issue that is benefiting some of these stocks is Donald Trump, who has now introduced this enormous tax changes to the tax regulations in the United States. And whether you like him or hate him, the fact is that is good for companies. So the companies have benefited from it, and we'll hear in just a minute when I talk about Apple, some of them substantially so. As far as Alphabet's concerned, they report on Thursday, and here we're going to be watching out for Google Cloud. Now, in Davos this year, that's the brand they were pushing. So as you walk down the main promenade, Google has been in Davos many times. In fact, I've been to a few of their parties, and Sergey Brin and Larry Page are regular visitors. The chairman, Eric Schmidt, was easily spotted. He was often seen by us within the Congress Center. So they are regular visitors to Davos. This year, they promoted the Google Cloud concept. So they're more and more wanting to get into the cloud, which is, in the old days, we used to keep all of our data and information on hard drives. First of all, in these big computers that would be kept in a computer center at the organization. Then it moved on to hard drives in our own computers that we had at home or on laptops. Now this is all moving into the cloud. So it goes onto huge computer centers that are owned by Amazon, which is the market leader, and that's somewhere where Alphabet is moving into it. So it has been moving into it, but is getting more aggressive. Already, They do about $10 billion a year in business. They did last year, and it's anticipated when their results come out on Thursday that Alphabet will report $14 billion in revenue for 2017, and the analysts are forecasting it'll go up to $18 billion in 2018. So that's a huge growth market when you think about companies like Berkshire Hathaway, who'd be happy with a 5% growth from its different subsidiaries. When you're talking 30 to 40% from the likes of Alphabet and Amazon, you can see why the ratings of these stocks are so different. The other thing that's going on here is that advertising investment, or the investment around the world in advertising, is still the biggest part of Google's business, and we need to keep an eye on that as well. Usually what happens is that the volumes grow, but that the price per click falls. So online advertising is the area where Google dominates. It shares the lion, or it has the lion's share of that, together with Facebook. And of course, this is what irritates publishing companies so much, in that these two companies who literally just aggregate content rather than producing anything are the ones who are benefiting most from online advertising revenues. On to Apple. And as you can see, this was the one disappointment. In fact, when you go through, just to put it into context, Amazon in the last month went from 1165 to 1417. Alphabet went from 1040 to 1175. Those are big jumps for both of them. On the other hand, Apple went from $171 a share to $168 a share. It was the only stock in our portfolio that went down in the last month. It tells you that the market overall, and that's shown by our Vanguard holding, went from 245 to 261. So that gives you an understanding of how the market generally performed. And Apple went down. As you can see, it's broken below. I just use a very simple 15-day moving average just to give you an idea give us an idea of the trend. But it's broken below that trend. Now, Apple reports on Thursday, and the expectation is, although they're going to come out with record sales for the iPhone X, the new, or iPhone 10, the new iPhone, which has got all the bells and whistles, it is expected, and that's primarily through the iPhone X and also the iPhone 8. It is there is concern that it is growing, that Apple is now starting to go X growth. We've seen this movie before. What always seems to happen is that the street or the investment analysts go off Apple, and then a little while later they realize, well, there's a lot more to this company than just selling iPhones. It's got a whole ecosystem from which runs from Apple Watches now to many of the other, iTunes, the apps, many ancillary services, but the big revenue generator is still the iPhone, and as a consequence of that, what happens to the iPhones affects the short-term share price. The other thing to look at here is total revenues. The anticipation is that Apple will come in at about 87 billion for its revenues, and earnings per share are projected to shoot up from $3.36 to $3.81. If either of those are underscored, then or not achieved, then you might see a little bit more weakness in the Apple share price. The big story, though, of Apple is the story about the tax cuts, and the reason for that is that Apple's got $350 billion US cash sitting outside the country, and up until Donald Trump coming into office, that money was not brought back into the United States because there are huge penalties, tax penalties, for doing so. What Trump did was he or his advisors, he saw the opportunity to bring that money back in and to earn a little bit of tax revenue from it. And as a consequence, he's made it attractive. So when Apple brings in its $350 billion, it's going to pay $38 billion in tax. $38 billion in tax. That's about half of the total tax revenue that South Africa generates in a full year, just to put it into context. So, and that is a bargain as far as Apple's concerned, because it can then bring all of that money back home. What Trump is hoping, and he was telling us this in Davos, was that Apple will then use that money to build new factories in America. Apple is looking obviously at ways of deploying it. A lot of the Apple products are made outside of the United States at the moment, but if it decides to build products within the United States, it certainly is going to have the wherewithal in the cash. That's the big story for Apple at the moment. It'll bring the money back in. How the tax revenues get treated, how the cash that comes back in gets treated, we'll know all about that on Thursday. So a big story on Apple, but the market is not getting terribly excited about the company at this stage. Here's a company that the market just loves, and boy, aren't we happy that we bought into Tencent. Now, there's a big South African interest in Tencent, always has been, given that Naspers bought into the company when there were only 30 people. It acquired 50% of the shares at that time, and provided the funding for it. It was about $30 million. Then when Tencent listed, Naspers went down to 1/3, about 34% of the shareholding, and that's what it still owns. If you were to take Naspers' shareholding in Tencent Holdings and sell it on the market, you'd get about 140 Rand for every 100 Rand in the valuation of the Naspers share price. So it shows you that Naspers is actually a cheap way into Tencent, and more international investors are starting to make this connection between the two. But that's the Naspers side. How's Tencent going? Well, it continues to invest in interesting assets. Together with Naspers, they've been buying into things like Flipkart in India. They're investing alongside each other. Very close connection between the two companies, as you would expect, the one being the 1/3 shareholder. Most recent investment, though, that Tencent made is an interesting one in that they got together with part of a group who bought 14% of the company, which is China's biggest mall developer. Yes, that's shopping malls. And the idea there is that by getting into the shopping malls, there's an opportunity to continue to grow an already astonishing 900 million customers that Tencent has, who all use the Tencent facility as their operating system. So when they start up their iPhones or their Samsungs or even their Microsoft phones, the software that's being used is an app in China anyway, and that software is the WeChat app. So Tencent Holdings is set fair. Also, there's, again, from Davos, the discussion when it came about attacking big tech did not extend to Tencent, because the view that the American government has of its big tech companies and the view that the Chinese government has of its tech companies are very different. Tencent and Alibaba and Baidu work together with the government. If the government says, we don't like you doing X, Y, Z, they deal with it accordingly. If the government in the United States says, we don't like you doing X, Y, Z to Facebook, Apple, Amazon, they fight them in the courts. And there's a very big difference in that. So the government threat to the Tencent Holdings business is a lot more muted in China. Also, the fact that Chinese government right now is looking for international champions. So it is actually supportive of the Tencent story. Let's get on to the rest.
Just on Tencent, sorry, from Hans. He just wasn't. Is Naspers not a better buy than Tencent now with the big discount?
It is. One has to remember that the Naspers, the story with Naspers, though, is that it's always going to be trading at a discount of about 20%. And what we're talking about here with Tencent is we're investing in a global portfolio. So if you've got rands to burn in South Africa, or not to burn, but rands that you want to invest, then obviously the logic says put those into Naspers. If you've got dollars and you're looking to appreciate the dollars outside of the country, then Tencent should be part of your portfolio. So it's a very sensible call that you're making there.
Thanks, Alec. And just a follow on from there, Dion wants to know your thoughts on Alibaba.
Yeah, Dion, I like it, man. I really, really like it. In fact, I almost succumbed to the negative pressure on Tesla to switch it into Alibaba. We've got to find a spot for Alibaba in the portfolio, and in the near future we'll be doing that. I saw Jack Ma in Davos, and he is just the most well, he's got what you want in a chief executive. He's so smart, but he's very humble as well. It was interesting, just standing there watching these players move around. As Jack Ma would walk, he had two people with him. Literally, it looked like it could have been his wife or girlfriend and maybe his personal assistant. And the three of them walked down, and somebody would come and tap him on the shoulder. And I didn't see what they were talking about, but he'd take a selfie or let somebody take a photograph of him, and Jack Ma would walk another 10 steps, and somebody else would come to him. Can I please take a photograph with you? So it's the kind of guy he is. Nice smile, chats to the guy for 10, 15 seconds maybe, and off he goes. It really was impressive just to see the difference between him and other leading chief executives, given that Jack Ma is now the richest man in Asia. So they, and often one gets these stories that come back about how he has his feet on the ground, how he's a very sensible, centered human being. I love a book, if you want to ever find out what kind of chief executive you should be following, I love a book by William Thorndike called The Outsiders. It's I study this book, and I'm busy going through it, I think, for the third time now. And you really want to invest in very stable human beings who've got their feet on the ground, who are not arrogant and full of their own egos. And you don't usually find, in fact, Thorndike says in his book, these guys, and he looks at 8 of them, they don't attend Davos. Well, Jack Ma does go to Davos, but his behavior in Davos is very different to the traditional CEO. And I can't tell you how obvious it is, the arrogance of some of these guys, the way they fly in on their private jets. I suppose a story that hasn't been told yet was how when Donald Trump came into Davos, it wasn't just one helicopter, it was 6, and they were flying in formation over the Alps and taking photographs and sending them onto their Twitter streams, and well, whatever. But the point is, Jack Ma really impresses me. His company is amazing. The Chinese support of the tech companies is another thing. The only thing I worry about it is, like somebody was talking earlier about Amazon. The share price has doubled in the past year. And when you're going into a stock where the share price has doubled, you should be kicking yourself for not buying it a year ago, of course. But secondly, you have to be pretty sure that you know the fundamentals well enough to say that we buy this one over the next 3 months, so we're going to be happy holding it forever. I'm still in that process of doing the analysis.
Sorry, Alec, I've got 2 more questions on Tencent and Naspers. The first one's from Maureen. Just wants to know about the Tencent holding, the difference between the one in the NASDAQ and obviously from the Tencent holding in the Hong Kong Stock Exchange. And Gavin just wants to know, obviously on Naspers, you said it should trade at a 20% discount relative to Tencent. He just says it's obviously it's what we know, it's much wider currently. What are your views?
Okay, on the first of those, the ADR that trades in America trades very, very lightly. So it's best through the web trader platform. You can invest in Hong Kong. It's much better to do that. So go for the Hong Kong one, where the volumes, that's the one that we've invested in, and that's where the volumes are high. There's also, Tencent also trades in Frankfurt, I think, where the trade is a little bit better. But the advantage you have with web traders is that you can actually go directly into those, into the main markets. The second point about Naspers, and I might have not communicated properly. In essence, what Bob van Dijk, the chief executive of Naspers, said at the investor day, which was on the 12th of December last year, the very first investor day they had in New York, he said that you can understand a holding company like Naspers could trade at a 20% discount because of liquidity issues and because of the South African listing. Being listed on the Johannesburg Stock Exchange is not like being listed in London, New York, even Hong Kong for global investors, because on the Johannesburg Stock Exchange there are certain other risks that come in, exchange control, which could be reimposed, etc., etc. So it does warrant a discount of, say, 20%. But he said only 20%, and the discount was trading at 40%. So their whole job that they've set themselves, the task they've set themselves on the investor relations side at Naspers is to get that discount reduced from 40% to 20%. And that's a substantial upside. Interestingly enough, and I'm not sure the market has picked this up yet, that discount should be narrowing in line with the valuation of the rand, because the rand is the share price of the country, and that share price is appreciated by 12% since Cyril Ramaphosa came in. What Van Dijk was telling them in New York was that there had been a massive outflow of money from South Africa as a consequence of the concern about the economy and the economic policies, and that was part of the reason why Naspers had this discount in Naspers had actually widened from 20% to 40%. So however you want to look at it, with the rand appreciating, it's a very bullish point for Naspers, because international investors, instead of running away from South Africa, will be coming back in, and when they come back in, about 1/5 of the JSE's market cap is in Naspers, so it makes sense. On to Facebook. Let's hit Facebook. You can see there is the share price is trading above its or the long-term or the simple moving average is still positive. Facebook will be reporting on Wednesday, that's tomorrow, and the thing to watch out for, they made an announcement on their news feed after being accused of allowing fake news to be propagated. Believe me, fake news is being propagated all over the media environment at the moment as a result of juniorization of newsrooms and people just simply not doing their homework. But anyway, it is what it is, and Facebook is now having to change its news feed and probably take a little bit of a knock on its numbers as a consequence of it, because the news feed generates 85% of its sales. Remember, this is a company that relies primarily on advertising sales for its revenue stream. We'll see what happens on Wednesday, so not really a whole lot more that we can say about Facebook at this stage. The Vanguard S&P 500, this is the umbrella fund that invests in the top 500 shares on a weighted basis of the New York Stock Exchange. And as you can see, it's had a wonderful run this year already, up from 245 to over 260. And that reflects how the US market as a whole has gone. Interesting to see the volumes are also improving down the bottom. Microsoft is a stock that we like a lot. We brought it into our portfolio recently on the strength of the view that Microsoft 365, which is a significant shift in the business model away from selling one-off products to having this annuity revenue stream, is going to be very good for the company. It's hit Microsoft's hit record levels. The share price, and Microsoft itself continues to benefit from its other investments too. We'll be looking out for their results also in the next week. This is the one that I've got to really I spoke about it a little bit earlier, got to scratch my head about. I think we all have to. Metro Bank will also be bringing out its quarterly results in the next couple of weeks. I'll be looking at those with a fine tooth comb to wonder, to work out why the share price, as you can see, has not really performed relative to the underlying growth in the business. But that is that tug of war that I discussed a little earlier between investors who are going to require to put more money into the company to grow or provide the funding which is needed for this breakneck growth rate that Metro Bank is enjoying, and the share price itself. So if they can find a different way of funding it, in other words, maybe come out and do some preference shares, maybe other types of debt funding, Metro Bank would see the pressure coming off its share price, but we need to watch that one carefully. Warren Buffett's Berkshire Hathaway, lovely jump again, beneficiary of the tax cuts, which is pretty obvious, and you see that previous jump in November, that was after financial results that the market liked a lot. And then Tesla. I've sped through the portfolio to get to Tesla, because Tesla is an issue, is a company where you have an incredible tug of war going on between the bulls and the bears. The biggest short position in history is on Tesla at the moment. It's an amount of what's 30 million shares, or worth $10.5 billion. So what that means is that people have sold shares that they don't own in Tesla on the expectation that the share price is going to collapse. A little bit like the Viceroy research guys who sold shares they didn't own in Steinhoff and are presumably doing the same thing now with Capitec, because they have found out, or they believe, that the share price is overvalued and it will fall when the rest of the market comes to their way of thinking. 10.5 billion short position at $340 an ounce. So that's $340 a share. So if Tesla's share price falls below $340 a share, then the short sellers make a lot of money. But you've got to wonder, how come, with all of the negative publicity that is going around Tesla, the share price still is around $350 a share, despite this huge short position? And if Elon Musk is able to deliver, and if the market continues to believe him, that those short sellers will be burnt even more. If they were out of the picture, one can only wonder where the Tesla share price would end up. As far as Tesla is concerned, they report next Wednesday on the 7th, and that's going to be a very, very big reporting date. The story that they need to explain to the market is the new Model 3, which is the mass market produced car, where there's many reports of production issues, production nightmares. They haven't come out enough. Every quarter, the focus is going to be on what's happening with the Model 3. The other thing is that Elon Musk's compensation package, or his pay package, if you like, has been adjusted. It's a little bit like what Koos Becker did at Naspers. Didn't take a salary, but had an upside on the share price. Of course, that's made Becker one of the richest people in South Africa. And shareholders should be delighted, because his benefits have been aligned with what has happened to their wealth. And it's a similar story on Elon Musk now. But the market, again, not everybody likes it, and the short sellers are using it as ammunition to say that, you see, this guy's greedy and he's profiteering, even though he's not taking a salary. It's a strange world, Tesla. People either love Elon Musk or they hate him. And the haters are growing, given that big short position. It was interesting to hear as well that Ford Motor Company came out, one of its executives, to say that they would never put together a battery farm in the same way as Musk has done at Tesla, but because they think it's a really bad idea that other people can make batteries better. They weren't making electric cars, though, when Elon was doing his first lot. So I'm still a fan. As a long term, I still think that he really is a genius who is transforming not just one but three industries. He's an entrepreneur as well. Read the book, the Ashley Vance book on him, and you'll see that this is a guy who's prepared to hang it all out there. And he was only one rocket launch away from losing everything, yet he was prepared to do that. The fourth rocket launch of SpaceX. He will have his detractors, but to me, you buy the shares, put them in a bottom drawer, and come back to them in a few years' time. As it is, he's done amazingly well for us, or Tesla's done amazingly well for this portfolio in the time that we've owned it. As you can see there, Tesla Motors is up 54% profit in rands, and it's 5% of the portfolio. So it's not a stock, given the different views on it, that you're going to go hugely overweight in, but at 5% of the portfolio, it's like an option on a South African boy who's making it big in Silicon Valley.
Thanks. A couple questions.
Sorry. Yeah, Stu, just before we finish off there, the annualized return of the portfolio, 34%, which gives you a reflection of how things have happened in the past month. Because in the past month, the rand is up 12%. So that would have really hit the portfolio hard. But the share prices in US dollar terms have gone up that strongly that it's taken. Last month we were sitting at an annualized return of 37%. Now we're at 34%. I mean, these are crazy numbers, but we are riding the exponential wave. Sorry, Stu.
No, all good. Harun just wants to know if you've got any thoughts on NVIDIA. It's an artificial intelligence company which is apparently is currently a good buy, had a good write-up in Fortune magazine.
I don't know it at all. Sorry, I wish I could help, Haroon. It's not one that I haven't looked at it. Don't know it.
Excellent. And then obviously the monthly question around Bitcoin. Any thoughts, Alec, from Michael Wolf?
Yo, Michael Wolf, the author. I can tell you a lot more about Michael Wolf, the author's book on Donald Trump, Fire and Fury, than I can about Bitcoin. Essentially, blockchain, again, going back to Davos, blockchain it's rolling. It's going to start disrupting industries. It's beginning to have practical application. How it's going to work is each of us will have our own personal, or do have our own personal number, and we'll use that number. And the belief is that every asset on earth will have its own number as well, and then you will own those assets, or they will be on your balance sheet, and you can then use those assets in the same way as you use other assets today. For instance, I mean, I'm going to just emphasize for effect, if I have a fancy pen, which is a Mont Blanc pen, which is worth, say, $1,000, I might use that to swap part of it, a percentage of it, ownership of it, with somebody else to, with Pret, to buy myself some lunch, say 1/100th percentage of it or whatever. So what Bitcoin, what the blockchain unleashes is going to be quite extraordinary. Whether Bitcoin itself is going to be a beneficiary is really questionable, because Bitcoin is a currency like all other currencies. When the blockchain really gets working, then all assets could be bartered in the same way as currencies are bartered. And this was the message that I picked up from listening very carefully to these experts who were in Davos, they were guys from Ethereum. And that if you think about this, imagine if there was a way that if you were bartering from one product to another product, that you could fractionalize the product that you're bartering to such degree that you could use it to buy a cup of coffee. So let's just say you had a big rock, as they did on some of the old islands in the past, and you used part of that rock, you sliced off a tiny piece of that rock to give to somebody to buy your cup of coffee, or in that case, your coconut juice. That's where we're going with the blockchain. The blockchain will have all of your assets will be registered to you, and you'll be able to transact with that. Now, how far are we away from getting to that situation? Could be 10 years, 20 years, 50 years, who knows? Could be 10 months. But the reality is that's where we're heading towards. So what happens to fiat currencies or things that don't really have an asset value? All the asset value is of a currency is what the other person is prepared to value it at. I don't know, but it certainly doesn't seem to me as though Bitcoins are going to be worth, when you've got that kind of a situation, which is down the line, that this cyber currency that you have is going to be worth tens of thousands of dollars, as some people suggest. What is helping Bitcoin at the moment also that came back to us is the fact that it is being used by the underworld, can't be traced. So you'd have people who want to transfer money from, criminals who want to transfer money across can do it very easily via Bitcoin. Their problem comes when they want to convert the Bitcoin into hard currencies, because that's where the authorities now start getting involved. So it's very complicated, all of this. And when it's too complicated to understand, it's best to step away from it. I'm not a fan of Bitcoin. I haven't traded in it. I haven't bought them. I haven't sold them. All I can say to family members who've suggested that they want to get involved in Bitcoin is that I wouldn't. And if they decide that they know better, then it'll be their experience, either to make a lot of money or not. But it isn't something that I work far too hard for my money. I would rather have it invested in something I do understand, rather than to take a gamble. If I'm going to take a gamble, and I don't, but if I were, I would rather go to the horse races and at least make somebody in that industry a little wealthier.
Thanks, Alec. Just one to end off with from Hans. Any other shares on your radar as we head into 2018?
Well, definitely Alibaba is one that I have been already toying with, but it was happened. Those who've been following this portfolio for a long time, it was like with Facebook. Oh, and I watched it and watched and watched, and eventually we did go in and buy Facebook, and it's done well. As you can see, there are 30% appreciation in rands. Alibaba is one that I would say right now off bat that I have been looking at and have been anticipating. The rest are still very embryonic, very early stages. A lot of stocks on a daily basis that if you like come across the radar and have a look at them and that company. You've got to know what that company is about. I know Tesla Spinny, if you recall, they did the deal with Solar City with the Reeve brothers. His name is Elon Reeve Musk, so the Reeve is his auntie's surname, and her sons, who are Elon's partners in Solar City, are also from Pretoria. So it was kind of a no-brainer for people who knew that background that there wasn't going to be a clash of cultures when they did that deal. Also with Tesla, they're looking to get into the mass market. To me, the big backstop for Tesla, if there were to be a problem, or if Elon Musk were looking like he was struggling to raise more funding, which isn't the case right now, is he's got SpaceX sitting there, and SpaceX is an incredible opportunity. There it is, a company that's complete blue sky, or black sky, I suppose you should say, if we're talking about space, which could be put into Tesla at some point in time to bolster the whole, if required. So those who think he's going to run out of money maybe haven't worked that into their calculations, but that's the point. It's a bet on electric cars. I do believe that electric cars are going, that the internal combustion engine in time will die and electric cars will take that over. So there's your long-term bet, your exponential bet on it. Amazon, similarly, the transformation that Amazon has made to retailing around the world, and you live in a country like the UK, you see it every day. If you want a book, you literally go online, you pay your $8 or $9, and the book arrives the next day or a day thereafter. It's just so much easier, more convenient than going into an old-fashioned bookstore. That's where Amazon started, and of course they now go in most other areas. That's what you got to do with making an investment, because you want to hold on to those shares forever. Alibaba, I'm getting close to the point where we've now got to just try and reshuffle certain things in this portfolio to bring them in. But are there others that are at that stage? No, not right now. Well, I think we've overstayed our welcome by a couple of minutes. I do a few minutes. I apologize for that. But I hope that you've enjoyed this update. And really the astonishing thing for me is that despite the strength in the rand and the appreciation of the rand, the portfolio has overcome that with some quite staggering share price appreciations in the last month. It isn't something that, when you look at that annualized return of 34%, you really mustn't bank that, because that's just super unusual. If we could have anybody in a portfolio, if you can have an annualized return of 15%, you're doing twice as well as the long-term average of the market. So our strategy is to invest offshore, to invest in the best companies in the world, the exponential potential in those companies. And all of these, with the exception, I guess, of Berkshire Hathaway and, of course, the Vanguard index, those are our little bolsterers. And we started off with big slugs in those portfolios, almost like having a bank, putting your money in the bank, and then you keep them there. When you find something good, sell those off and put the funds into the new stock. That has served us well. I'll keep looking and I'll keep updating you. So look forward to our conversation again next month.
Thanks very much, Alec.
So long for now.